Hi, I'm Preeti and my valuation is for Costco Wholesale, which trades today at $969 per share. It's listed at Nasdaq. My recommendation is buy on dips. Costco is one of the best businesses in the world, but the stock is a little expensive currently, in my opinion. My analysis says it's worth about $879, roughly 9% below today's price. So I wouldn't buy at this level. I'd wait for the price to dip towards around a level of 800, and that's when I would suggest that people can buy and accumulate the stocks. Over the next few minutes, I'll walk you through my model sheet by sheet and show you exactly how I reached at this conclusion. So moving on to slide 2, but before any numbers, let me explain how Costco makes money. Costco looks like a shop, but it's actually a membership club. To walk in and buy anything, you first pay an annual fee, which is about $65 to $130 a year. Costco has 76 million member households paying that fee already, and they make up about 60 to 75% of Costco's entire operating income. Low prices attract more members mean Costco buys in bigger volume means suppliers give better deals. It sits on a fortress balance sheet, about $8 billion of net cash with $13 billion of operating cash flow every year. So it funds on its own and could withstand any downturn comfortably. About 73% of revenues come from the United States, and it's a concentration risk. However, it also means that the other countries where it's not present is a growth runway. Moving on to slide 3, why Costco is a great business. First is membership lock-in, where 92.9% of members renew every year. Kirkland Signature, Costco's own brand, generated $90 billion in sales. It sells everything priced 15 to 20% below the big national brands. Costco pays staff well above its competitors, so people stay, service is better, and it's hard to copy. Talking about my assumptions, revenue growth is at 8.5% a year, anchored at 10-year US nominal GDP growth rate. Costco can't grow much faster than the economy it sells into, so tying it to GDP keeps me disciplined. Three real drivers of this are opening new international clubs, about 900 by 2031 versus 890 today, growing online sales and periodic membership fee premium. Moving on to profit margin, now at 4.7%, rising to 5%, a tiny increase of just 30 basis points over 5 years. This improvement comes from a mix and not price. More Kirkland sales and more membership fees spread over fixed warehouse costs and not from charging customers more because Costco caps its markup by policy. Talking about capex, it's 2% of sales. It's the money spent building new warehouses. It's held at Costco's historic average levels, and the tax rate is 25% standard. For net working capital, Costco has a negative cycle. Membership fees are prepaid, collected upfront. Inventory turns faster than payables, and hence I have kept it at 0.5%, which justifies the historical average as well. Moving on, the left chart shows free cash flows over time. The navy bars are the actual past 5 years, and the gold bars are my forecasted 5 years. You might notice that free cash flow dips slightly from 2025 to 2026. Let me explain that. Because it's deliberate, the historical bars are Costco's actual reported cash flows, and FY 2025 was unusually high thanks to one of those favorable working capital swings. My forecast doesn't assume the same tailwind repeats. I normalized working capital to steady level, so 2026 starts from a slightly more conservative base and then grows steadily from there. The right one shows the components that I build for the cash flows of next year's. Moving on to the next slide, talking about the WACC, which stands at 8.96% because dollar in 2030 is definitely expected to be not as the same as it is today. The cost of equity is calculated using CAPM, where the risk-free rate is 4.28%, which is the 10-year US Treasury rate. Moving on to the ERP, which is of Damodaran's at 5.5%. Costco's beta is 0.87, and using the cost of debt, I have considered Costco's bond trading at 4.5%. We arrive at 8.96% of weighted average cost of capital. Notice that the weighted average cost of capital is almost entirely equity weighted. That's because Costco barely uses debt. It actually holds about $8 billion more cash than debt. The terminal value is done two ways. My forecast only runs for the next 5 years, but Costco doesn't stop existing after that. So I needed to capture everything. And I have looked at the terminal value in two ways. Method A, I assume that in 2030, if someone goes to buy Costco, it would be at 26 times its EBITDA. This gives a value of $879 per share, which is about 9% below today's price. Method B is a conservative cross-check, which is the Gordon's growth model. This assumes Costco's cash flow grows over forever at 4%, which is the US nominal GDP growth rate. This gives a much lower value of $405 per stock, about 58% below. And I'd stress that I've been deliberately conservative on my inputs, and I capped the growth rate at 4%, which is the economy's ceiling, rather than pushing it higher to flatter the number. So $405 is intentionally the worst case scenario, not a number I'm trying to inflate. Now, I used the 26x as the forward multiple for my 2030 exit because it keeps Costco's premium roughly intact while allowing a little to fade over next 5 years. Method B, by contrast, strips the premium out completely, which is why it's so much lower and which is why a textbook DCF always makes Costco look expensive. Moving on to my second method of valuation, which is the relative valuation in slide 7. The table compares Costco to Walmart, Target, Kroger, and BJ's. My EBITDA forward multiple in the previous slide was 26 times against the today's multiple of 31 times of Costco. It's the same stock, just measured against a forecasted future profit number, allowing it to fade just a little, and forces us to think, is Costco's premium sustainable? Looking at my previous slide, the 26 times EBITDA says mostly yes. The Costco trades at 31 times its EBITDA now. The typical peer trades only at 11 times. So Costco is priced at nearly 3 times its competitors. When I apply those peer multiples to Costco's own numbers, I get implied values of $360 to 440, somewhere between $360 to $440, far below today's trading price of $969. Moving on to slide 8 and putting it all together and stress testing. The left chart is a football field, and it shows DCF exit multiple at $879, DCF Gordon's at $405, relative EV EBITDA at $432, and relative P is at $440, versus the Wall Street's target is 1,083 and the current trading price is 969. Every method I used lands below today's price. The only thing above it is the Wall Street's target, which is based on momentum and not intrinsic cash flows. On the right, we have the sensitivity analysis, and the pattern is clear. Costco only looks cheap if you assume its multiple expands towards 31 times, which is too aggressive. At any reasonable assumption, it's overvalued. Moving on to slide 9, why buy on dips? But before that, we can't deny the fact that Costco is a phenomenal business. It may be the finest business models in retail, a loyal membership base, a powerful flywheel, decades of runway, and defensive beta. Although there are some risks involved, like multiple compression, where what if market sentiment changes suddenly, or too much dependency on the US economy. Also, renewal sensitivity, where each percentage is $150 million of lost high margin fee income. So, being a great company and being a great buy are two different things. Moving on to the final slide towards the conclusion. Today's 969 traded price is about 9% above my fair value of $879 with no safety cushion. So buying right now doesn't make much sense. Both DCF approach and peer comparison show that Costco lands below today's price of $969. My recommendation is buy on dips. If you already own Costco, hold it. If you're putting fresh money, buy the dips and build towards a price of $800 when it reaches about $800 rather than chasing the all-time high. Thank you.